What do you do if you over-contributed to a traditional IRA? I was preparing a client's tax return the other day and encountered this very situation. Upon reaching out to my client, she was aware of the mistake but had no idea on how to fix it. That's probably why she reached out to me to prepare her tax return. You see, she was already covered by a retirement plan with her employer, and her adjusted gross income was too high to allow for a deductible IRA contribution. In case this ever happens to you or someone you know, there are some very good options, including a backdoor Roth IRA conversion, so it's really not something to worry about too much. Stay until the end and I'll show you how a backdoor Roth conversion is actually reported on a tax return. Hi, I'm Noel Lorenzana, your friendly neighborhood accountant. So I'm preparing a late in the year tax return for a new client, let's call her Jane. It was a fairly straightforward return, but I did notice that there was a tax form indicating she made a $6,000 contribution to a traditional IRA, or individual retirement account to be precise. My attention always goes up when I see IRA contributions because they can mean very different things. It could be a standard deductible IRA contribution, it could be a non-deductible IRA contribution, although not as common, or it could be that I haven't received all the taxpayers' information and maybe they did a backdoor Roth IRA conversion. So I reach out to my client Jane and ask her about the IRA contribution. She informs me that she knows she messed up and didn't realize that she could not make a tax-deductible IRA contribution since she was already covered by a retirement plan at work and exceeded the income limits. I let her know that it's not a problem and that she has two options from what I could see. She could do nothing and I would report the IRA contribution on her tax return as a non-deductible IRA contribution. This is done to track the non-deductible IRA contribution so as to avoid getting taxed twice. Just so you know, any money you contribute to a traditional IRA that you do not deduct on your tax return is a non-deductible contribution. You must still report these contributions on your tax return on Form 8606. Reporting them saves you money down the road because the money was already taxed. And if you're not keeping track, it could get taxed again. The second option, and my recommendation for her, was to convert the money to a Roth IRA, which is also known as a backdoor Roth IRA conversion. Technically, she could have done this for the tax year 2021, but in her case, it would require an amended tax return since the tax forms needed wouldn't arrive until sometime in 2023. In addition, she would need to pay tax on the contribution earnings as well. Personally, I don't like amending tax returns unless I need to. My recommendation for her was to recharacterize the 2021 IRA contribution to the tax year 2022. She could then convert that to a Roth IRA. Recharacterizing simply means moving the contribution from one year to another year. There are some pitfalls on doing Roth conversions, like if you have existing IRAs, then you run into taxability issues with the IRS's pro rata rule. Other pitfalls include not following the process correctly. I talk about this in a previous video that I'll link up here. Anyway, my client was delighted that I was able to smooth this out for her and give her a great option and taught her something that she could use going forward, which is implementing a backdoor Roth IRA in her tax planning arsenal. A backdoor Roth conversion is reported on Form 8606 as shown here. On line 1, the non-deductible IRA contribution will be indicated. On line 8, you'll indicate the amount that was converted to a Roth IRA. Presuming that there were no existing IRAs, then line 13 will be the same as line 8, showing that the distribution from the non-deductible IRA is not taxable. You would also complete part 2 as shown here on page 2, essentially showing that none of the conversion is taxable. Your situation may be different, especially if you have existing IRAs, which would create a taxability issue. Speak to a tax professional and please don't do this on your own. I've seen too many messed up conversions that I either couldn't fix or I didn't want to spend the time to fix. Finally, on page 1 of Form 1040, line 4A, it will show that there was an IRA distribution, but that none of it was taxable. Another option that I forgot to mention, if you over-contributed to a traditional IRA, depending on your income, if you're able to make a Roth contribution because you're under the contribution thresholds, you could actually recharacterize the non-deductible IRA contribution to a Roth contribution directly. This avoids the backdoor Roth IRA complications, but you also need to qualify based on income limits, and you need to do this before the filing deadline, including extensions. That's about it. My new client was delighted that I handled this for her and guided her properly. Prior to this, she and her husband self-prepared their tax returns, and that's a whole nother story. I'm a firm believer that you'll get the best results by hiring a true tax professional. Let me know if you have any questions in the comments section below. Be sure to check out this video here where I summarize the backdoor Roth IRA process. It's a great strategy to contribute to a Roth IRA indirectly, especially when you exceed the income limits. Please do me a favor and like or subscribe if you've received value. It really helps me out a lot. If you're watching this, consider yourself a member of the Ask an Accountant community. Thanks for watching and see you in the next video.